I'm Tom Lorenzini, Senior Vice President at the RMR Group and also Senior Vice President at Tremont Realty Capital. RMR, based in Boston, is an alternative asset management firm, about 40 billion of assets under management, solely focused on commercial real estate. And Tremont Realty Capital is the credit arm or the lending division of the RMR Group. So through the RMR Group, we manage several publicly traded equity REITs as well as several private capital vehicles, and we manage the assets inside of those entities. The vertically integrated platform manages all types of real estate for our client companies, including multifamily, retail, hospitality, traditional office, medical office, life science, senior housing. So broad breadth of product of asset classes, some 2,000 single properties across the country, 30 offices across the country, and as I said, based in Boston. Tremont Realty Capital, as the lender, we provide middle market financing, generally in the loan amount range between $25 to $75 million on value add or transitional middle market commercial real estate, which fits very well with the RMR platform, given our experience in the middle markets, and that helps translate into the lending into the middle market space. So when we think about the markets, we really break them down loosely through three sectors. Upper market, asset values north of $100 million, most likely institutionally owned, most likely Class A or trophy type assets. The lower end of the market, or the small end of the market, asset values less than $25 million, generally with sponsorship, maybe local individual owners or mom and pop type owners. And then the middle markets, which is arguably 80% of all commercial real estate values fall within the middle markets, is kind of between $25 to $100 million in asset value. Now, the middle market doesn't mean smaller markets. It doesn't mean geographically smaller markets. It doesn't mean smaller population centers, smaller MSAs necessarily, and it certainly doesn't mean lower quality assets. It's really more of a function of being kind of the largest sector of real estate. But there's also in there what you have is generally a value add type real estate. It could be opportunistic. It could be core plus. So we're generally not talking about trophy assets. We're generally not talking about Class A newly delivered assets. These are generally solid B assets, A minus assets. For a point of reference, might be a $50 million multifamily asset that was built 10 years ago. And there might be an opportunity there to refresh the units in an efforts to remain competitive, and in efforts to push rents and create some value. So that would be a typical value add play that we would see in the middle markets. It could be an industrial asset, maybe that was built 10 years ago, and those tenants are now rolling and with lease expirations, but there's an opportunity to move those rents to market, and there's an opportunity to create some value that way. And sponsorship is looking to create value. They're going to need flexible capital to do that. That's a very traditional middle market play. Also in the middle markets, when we think about the owners of the real estate here, we're really thinking more about private capital than institutional capital. Now, when we talk about private capital, we're certainly talking about well-capitalized sponsors that might have institutional equity backing them. However, they are the boots on the ground as the private capital operator, because it's not efficient for the large institutions to invest into the middle markets, because it's a much more granular holding of real estate than if you were at the upper end of the market buying much larger multi-hundred million dollar $100 million assets. On the middle market side, a couple things there. Because of big preponderance of those assets might be value add, or there might be some sort of value proposition or value creation that they're going through. They're generally looking for some flexible capital. Middle market lenders or borrowers, I would also say, are looking for relationship type lenders. Now, historically, the banking community, the regional banks and the local banks really were the go-to lender in this space up until the last couple of years, when in 23 we saw a couple of pretty high profile solvency issues at a couple of banks. We saw kind of deposits across the sector transfer from the banks, and as a result of that, the banks pulled back on their lending. And while they have come back a little bit, there's still a void that's there. So in order for that void was financing the types of properties, these value add transactions, things like this nature. So sponsors today are looking for that relationship lender to replace the bank that may no longer be there for them. When we think about like the upper end of the market, right, we start thinking about institutional Class A properties. Those are generally going to be financed more often than not, kind of long-term fixed rate. There's low risk. There's lower probability of default. In the middle markets, borrowers are looking for creative financing because there is value creation. So they're looking to acquire the asset, then they need to improve the asset. And that's generally a 3 to a 5 year business plan, and they need a lender that's going to work with them to do that. And again, they're looking for that relationship. I mean, we look back at our own history and our portfolio here, and we have multiple borrowers that come back again and again to replicate the process and to work with the lender that they know and that they trust, and that's critical in the middle market space. Well, the middle market it's the largest market. It's also the most fractured, if you will. There's really there's no lender or lender type that really kind of controls the market, if you will. And that provides opportunities. As a credit manager, and why we look at this space, we believe we're able to achieve higher risk adjusted returns. And one of the reasons we're able to do that really is because the financing here with the banks pulling back has allowed us to increase market share and has allowed us access to a group of borrowers that traditionally maybe we wouldn't have seen because they were being banked by the regional banks, and they're seeking new relationships. So it helps us grow our portfolio. We also think that with the sponsorship that we have here, we're talking about well-capitalized sponsors that have done this before. But they generally tend to be a little bit more conservative. So we're seeing a little bit more stringent on the debt service coverages and on the loan to values and things of that nature that maybe we wouldn't see at the upper end when we're dealing with an institution that has much more negotiating power. So the other aspect that we see with middle market lending as well is, from a credit manager's perspective, we're looking at the diversity that we're able to get with our pool of capital. So we're able to do much greater number of loans with an average balance, again, between that 25 and $75 million range, which is much more, we're able to diversify risk, geography, property type, borrower, versus lending at the higher end of the spectrum, or maybe you don't have as much diversity because you're writing much larger ticket loans. Yeah, I think it's very positive. I would tell you that we come in the last 24 months, we've kind of come through, or really the last 12, kind of come through a little bit of a decline in value there, right? That was coming out of 21 and 22. We saw rates come up. Now they've started to come down. And because of that, we've seen values have we either passed the bottom or through the trough, and they're starting on the upswing, which is a terrific time to invest as an owner in the real estate. And as a lender, it's a terrific time to lend on those same assets because we're going to go along with the borrower there into a period of increasing real estate values. Now, in 21 and 22, there was a significant amount of debt capital that was in properties that were acquired and that were financed. and those loans are all coming due. So there's a lot of press, or a lot of talk about this in the press, the wall of maturities that's coming. It's some $2 trillion by some counts over the next couple of years. All of that financing is going to need to be redone. So two things are going to happen. They're really, there's a refinance that needs to get done, or if there's if there's been a decline in value and they're not able to refinance because rates are higher now than they were before and values are slightly lower, that asset needs to be sold. And if that asset is sold, then there needs to be an acquisition loan that goes with that. So that's a terrific time as a lender to have a significant amount of transactions to choose from. Borrowers are optimistic because rates are coming down. So we're starting to see capital come in from the sidelines on the acquisition side. So there's going to be more trade. So there's more liquidity. And that's all positive news for both borrowers and for lenders. So we think the next several years are a terrific time to be in the space. Granted, there's been some near-term headwinds right now with tariffs and things of that nature, and TBD on how all that is going to play out and how sticky some of that the tariffs are and things of that nature, because that could have an impact certainly on the economy, which could impact hotels, and it could have an impact on industrial, due to imports, et cetera. Probably not a bad thing for multifamily. But barring that and the long-term trends here for the next several years anyway, we think are very, very positive, and we're excited about what's to come here.